Afternoon. Good afternoon. We are going to go ahead and get. All right. So good afternoon. Shatika Hassa here, CEO of Hustle Financial Solutions, where we help you retire before you expire. That's what you hear. You hear some thundering and some storms and some lightning going on here. I'm doing great, doing fantastic. All right. So I'm on a few different networks, but wanted to come back today for a part two to answer any questions that you guys have around life insurance, rather it be whatever. Let me get to the comments section on the YouTube so I can make sure I can see that. Hey, how are you doing over there? Nightway, blessings to you as well. All right, so just to tell you who I am, if you have never watched this channel before, I am Shatika Hass. I primarily help business owners and career professionals to structure their finances and their accounts for tax-free retirement income that they will not outlive. That's ideally what I do. And so if you know anyone that can use those services, that's how I can be of assistance to you or them. So I'm here to answer questions that you have. I know yesterday I came on and I unpacked a few things, but I didn't really talk a whole lot about the how. The how, like how do you use the whole life policy? How do you use the IUL? So let's jump right into the how you doing, Kendrick? So today I'm going to talk a little bit about the whole life, and then I'm going to talk about the IUL. You can't use the term policy too much except for death benefit. That's primarily what it's used for. Okay. It's used to leverage your death benefit amount. So if you can't afford a permanent policy, because of your finances, then term is great to capitalize on. So you can use that to extend what you already have. A lot of times IUL actually will have a term inside of it, rather you know that or not, to extend the amount of death benefit that you would have in an IUL. But it could be structured that way. There's a lot of ways you can structure to add term inside of your IUL policy as well. So if you need that for your budget, because everybody has their different finances. So at the end of the day, the whole life policy primarily, if you hear anybody saying, I can help you with your debt payoff within 9 years, no matter what your debt is. You've probably heard this before. Rather it's a house, it's, student loans, whatever. I can help you get all of your debt eradicated within 9 years. They are probably talking about a whole life policy. All right. So there's a way that you can structure the policy to be able to allow you to pay the premiums. And then when the premium generates the cash value, you can now take that cash value and be able to pay off your debt. So that is something that a lot of people are not aware of as well. So now you're basically using your money more than once. You're paying off the debt, you have a death benefit, and you're paying off and you're making money, right? And you're generating cash value inside of the policy. So your money is being used 3 different times, if you will. Actually, more than that. It depends on what kind of strategy you're trying to use. So there's a lot of different strategies that people are using, but if you're using it for a debt policy, it can be done. You can structure it and you'll know exactly when all of your debt is going to be paid off, because the policy is going to be structured around you making your payments and your premiums so that you can then take that money and pay the debt off, right? So people are like, well, I'm already in debt. How do I do that? Well, that's another whole consultation. This is going to be a really quick one because I don't want the storm to get me, but I definitely want to make sure I made you aware that that is one of the uses for that policy, a whole life policy, right? Another reason why people use whole life policies is to make sure that they have access to their funds like a bank. So they oftentimes want to structure what we call a private banking. So they structure that banking policy to be able to be used so that they don't have to worry about not making enough money, right, in their bank account, because we know that bank accounts don't really make any money. And if you do know anything about finances and what the banks do, the banks actually have something called the BOLI, the bank-owned life insurance. So they use carriers to be able to build their accounts. And so you can do the same thing the bank is doing, right? So going to the carriers to help you build your bank account, right? So, but yours come with a death benefit. Yours come with, of course, living benefits. So if you have any type of challenges medically, yours will also come with, protection from lawsuits. So if you ever get sued, they can take everything else, but they cannot take the money that's inside your cash reserves. That's why the wealthy use these policies, because they want to make sure that they are protected. Let's say you don't have a trust, right? Because you don't want a trust for whatever reason. and you just want to make sure that your money's protected from lawsuits. Well, you can get it, make sure that you have your actual life insurance policy to protect your money and from lawsuits as well, of all kinds, right? Because the courts cannot see what's inside of your cash value inside of your policy. So that's why it's protected. Okay, let's be clear. Bless you as well, sir. How you doing? All right. And so basically, you want to make sure that we are taking a look at that because, in this time with everybody, lawsuit hungry, you want to make sure that you can definitely, protect your money from lawsuits, but also you want to protect your money from market volatility. So while you may have your funds inside, all these different other, assets classes like stocks and mutual funds, you can actually keep your money from being lost in the market by putting it inside, of course, of risk-free cash value policy. But also you can participate in the market when the market goes down, but you don't participate in the market when the market goes you don't participate in the market when the market goes down and crashes and has a negative, but you do participate in the market when the market goes up and it has a positive. And so you can have capped or uncapped. In other words, you can capitalize on all the gains, or you can have some restrictions, and it can be built out based off of it being capped or uncapped. So if you don't know what those terminologies mean, basically you can structure it to have an actual fee or not based off of being capped and uncapped. So there's some different technicalities that you can actually speak to your life insurance producer about. Okay. And of course, I am a life insurance producer. I am a retirement consultant. I am a retirement coach. So those are some of the hats that I wear. But whoever you are using or working with, make sure that you ask about the capped and uncapped strategy as well to see how your money is being credited towards your account. Now, in a whole life policy, is primarily going to look like the stocks, right? In terms of how they credit your account. Now, for the whole life policy we talked about so far, if you're just joining us, just do a quick summary, go right back, just do a quick rewind, if you will. We talked about the whole life policy and how it's being used. We're using it to pay off debt. We're using it for banking. And those are the two main uses that people use the whole life policy for. Yesterday, I mentioned to you that you can pay it off in your entire lifetime, or you can structure it to pay it off in 7, 10, 20 years. That the less amount of years you take to pay it off, the more expensive the premiums are going to be. And of course, the younger you start, so you want to start before your next birthday, the less expensive it is as well, right? And some other factors that they look at to determine what your premiums are going to be in terms of how expensive it is, of course, is your driving history, your medical records, your credit history, your build. So if you're overweight or underweight, I'm not just kidding, but overweight, not underweight. But overweight, that can absolutely impact the amount of money that you're actually spending. So want to make sure you're taking a look at all those types of things. Are you a smoker? Are you not a smoker? And of course, they're just going to look at all of that. They want to make sure that you can, of course, pay the policy as well. So, what kind of debt are you in? So that's why your credit is important, because I've actually had someone to get downgraded because their credit was bad. Everything else was good, but their credit was bad. You said you're asking me about my thoughts on term. So I actually had talked about that. So my thoughts on term is it's great if you're looking to leverage, right? So if you're looking to leverage now and you want to get more death benefit, then term is what you want to do, right? You want to get a term policy if you're doing it for a budget, from a budget perspective. If you're going to get term, though, make sure it has two components to it. If you're going to get term, number one, you want to make sure that is a return on premium. In other words, you can get all of your money back. Okay, so 65 to 100% of your money can be returned to you if you should live, because 98% of people are going to outlive their term policy. Let's be clear. Okay, so only 2% of people will ever use their term policy, because most people will outlive them. So make sure it has a return on premium component if you're going to use the term policy. And then secondly, you want to make sure that it's convertible. So it can be converted to a permanent policy so that you can take advantage of all of the other benefits that a permanent policy is going to be able to use. So make sure you take a look at that as well. So yes, those are my thoughts on term. And so I actually still have a term, honestly, because I purchased it years ago when I didn't know anything about insurance, and it'll last me till I'm 95. So I decided to hang on to it, right? So why get rid of it once I know more about policy? So I actually have a term, I have a whole life, I have a index universal life. They all serve different purposes. right? So it's just about, whenever you consult with a professional such as myself, you want to make sure you go with the end in mind, right? So begin with the end in mind. What is your vision for your policy? I know somebody that has 15 policies. There's a vision for each one. There's a policy for every house the person has, right? Because it can be used for banking. So it just depends on what you're trying to do. You might want to use it for, each one of your children. They all have their policies. You can have as many policies as you need to have to accomplish your vision, right? So that's why you need to begin with the end in mind. So what is your vision for the policies that you have, right? Okay, so great question, Daniel, over here. All right. Any other questions while I'm going along? So let's get back into it. So whole life, I just pretty much told you the two reasons for that because I'm not going to be long. So go ahead and ask your questions now if you have any questions. And then we're going to get right into the index universal life. Now, of all of the three, since you asked what my thoughts are, from a retirement perspective, the index universal life is very attractive for most people. And I'll tell you why. For one, you're going to get more death benefit than you will with a whole life with an IUL. Okay, so for the same premium amount, you're going to spend the same amount and get more death benefit in an index universal life. Of course, the whole life, there's a guaranteed death benefit in an index universal life. What guarantees the death benefit is your ability to not treat it like a bank account in the sense that you are overdrafting. Because if you overdraft an index universal life policy, you will not have a policy. You will lapse the policy. So the goal of the index universal life is to grow your money exponentially faster than with the other types of policies, because it actually models the behavior of the S&P 500. So there's index universal life policies that have done 27%, 33%, 55%, but there is no, we cannot give you any guarantees, right? And of course, this is not financial advice that I'm giving you. I'm not giving you a consultation right now. I'm just giving you some facts. So historically, you can actually see what the prospectus has been in these different policies and these different carriers and see, how has it been performing? And how is the carrier performing, right? Are they A-rated carrier? Those are some of the questions that you want to ask because all carriers are not created equal and all IULs are not created equal. Some are performing extremely poorly and others are performing, of course, extremely well. So double digit, right? So want to make sure that you are actually getting an index universal life policy that's going to perform well for you, that's going to be able to help you accomplish your financial goals. Because literally you can be in one carrier that's doing 66%, what's called participation rate, versus another carrier that's doing 115% participation rate. And that's over 3 years. It's going to take you to accomplish the same amount of growth in that account because of how poorly the participation rate is. So you want to know what the participation rate is in these carriers whenever you're getting into these index universal life policies. So yes, generally, yes, the IUL, you're going to get more death benefit. You're going to guarantee guarantee that it's not going to lapse by making sure that you have a cash value in there. The goal for most people, the way they pay into the index universal life is they want to max fund it in the beginning years so that it can grow, because that's what happens. The longer you have the IUL, the better off you are, because the expenses are in the beginning years of it. You have a surrender charge the first 10 years of it. So if you're doing infinite banking, the reason why people use whole life, what infinite banking versus an index universal life, is because there's no surrender charge in some carriers. Now, this, again, all carriers are different, so you want to make sure, but most carriers are not going to have a surrender charge in the first 10 years in a whole life. So that's the reason why you use that. So if you want to take your money out, and again, this is another thing I didn't mention yesterday, and I got to tell you this today. So you can use your money another way, right? Because when you take the money out for say emergency loans or whatever the case may be, your money is not going to stop compounding. Your money is still compounding inside that policy, okay, until you pay that money back. Now, you are going to have a fee at the 13th month in terms of the interest rate that you got to pay. The first 12 months of that loan is absolutely no interest, right? For the first 12 months. But at the 13th month, you're going to start having to pay that interest back, depending on the carrier. It can be anywhere between about 5% to 6%. So let's say if you're in an index universal life and it did 20% that year or 12%, you minus basically, of course, what the what that amount was. So you want to make sure you understand that your interest is 6%. You subtract that from what's being compounded, but just because you took the money out to use it over here, that does not mean that the compounding stopped. It's still going to compounding at the exact same amount. So that's what people are understanding more and more. And that's the reason why they're leveraging the index universal life. All right. So it's going to be the one that's going to make the most cash between the whole life and the index universal life, because it's based off of course, the performance of the index universal life, of the S&P 500. So if the S&P 500 doesn't do well, and people are cringing everywhere, right? You don't have to cringe if you have an IUL, because your floor is a 0 unless you pay for a floor of 1. What is a floor? Meaning that you can't lose a penny inside of an index universal life policy, because your money is not directly tied into the market. Your money is just modeling the performance of the S&P 500, but it's not tied into the market like it is with a stock or a mutual fund. So that's the difference between those, right? So people are interested in the growth of it. If they're not interested in losing any money, then that's the route to go. If your risk tolerance is low, you want to take a look at an index universal life policy, because you have low risk tolerance. All right, so let's be clear there. Now, the IUL, of course, and the whole life, you can have different riders attached to them. And the IUL ideally is going to come with the living benefits already inside of it. When I say living benefits, I'm talking about chronic, critical, and terminal illness, long-term care. That's the reason why, some people get them on their aging parents. They want to make sure that their aging parents is covered. Say if they need some type of facility care because they, have dementia or, heart attack, cancer, stroke, these different things, they can access those funds and not have to go bankrupt trying to take care of their aging parent or themselves or their spouse, right? So the index universal life policy already has the living benefits for the better carriers. They already have it already built in. You don't have to add it as a rider. Now, on a whole life, you may have to add it in some cases as well. But living benefits is the reason why people get these permanent policies, because they want to make sure that they don't, if there's some type of medical challenge that they didn't plan for, that they are going to be covered. So just understand that. All right. So let's see if there are any other questions. Oh, awesome. Kendrick, you definitely do well with that. Are there any instances for those who are soon to be or retired military when it comes to these policies? Thank you. Yeah, it's a great question, the Night Way, and thank you for the service. If you're talking about yourself, I definitely served as well in the Army. So let's go Army. Excuse me. So when it comes to your, retirement, with your retirement with your military, you want to take a look at that TSP. So that TSP is a mutual fund pretty much, and you can lose money just like you can with anything else, right? And so like I did do something with a young lady. She had 1.2 in hers, and she wanted to be able to safeguard it. So we took 800 out and we put it in an annuity. We have some really aggressive annuities, that actually will grow for you exponentially fast. Like I did the math on one, just to be clear, $100,000, would grow to $350,000 in 17 years. I can't make that guarantee. But basically 285% participation rate is what we have for annuities. They're very aggressive products. There's no loss. So what we did was we took the risk away that the TSP has, right? So she doesn't lose any more money, but she's able to make money. And then of course, that's what she did two. So the one was for the growth type of annuity that we have, which is a fixed index annuity. You want it to be indexed because not all annuities are created equal. You don't want a variable because you can lose money. So we gave her a fixed index annuity so that she was able to definitely, protect her money from losing money in the market, but also generated herself an income. So one was a growth annuity and one was an income annuity. Both were fixed index, so we don't have to worry about her losing any money, but she will only grow. But that growth one is the one I'm talking about, was a 285% participation rate. So that would actually, for every 100,000, it would actually grow to $1 million in 17 years of, and she started it at 59. So basically, it's a really aggressive product, but it takes away the risk. So an annuity can do just that. What happens with an annuity is, as long as you don't annuitize it, right? In other words, you turn it on to be able to be annuitized, meaning that you'll have that income. If you just like did your 10% penalty-free withdrawal every year, okay, which that's what comes with that. Most people can live off that if they have a sizable amount in their annuity. If you live off 10%, you don't have to annuitize it, because once you annuitize it, that means that you have to use whatever you don't use in your lifetime. That's it. That's all you have, and your beneficiaries are not going to get anything, right? So there's been horror stories because people didn't understand that. And they thought that if they annuitized, it was okay. It is not okay to annuitize. So just understanding what annuitize mean, if you have an annuity, is a number one thing I would tell anybody, just to make sure so that your beneficiary will definitely get something if something was to happen to you. So whatever payments you don't use, your beneficiary will be able to get that. The wonderful thing about an annuity is that you don't have to have the medical, right? So there's no medical for that. And you can still access your funds, 10% of it. You can access more than that, after 10 years, after the surrender charge, 100% of your funds. But most people that want long-term growth, they go towards annuities because it's more aggressive and they don't have any risk. So hopefully that answers your question with that. So TSP let me be more clear. TSP is what's called a qualified fund. Qualified funds can only go into a qualified fund. So you can't use a TSP to go into an IUL or any type of life insurance product, okay? Because it's non-qualified. So life insurance products are non-qualified, meaning that when you think about qualified means you're qualified to have to pay taxes, okay? So 401k, 403b, 457, 414, all of those, TSP, IRA, you're qualified to have to pay taxes. People love Roths, but Roths you still can lose money because it's a mutual fund, right? So you can lose money in a Roth as well. So people are looking at doing Roth annuities, right? In terms of like making sure that they can still have tax-free distribution, but it's a Roth. But of course, the thing about the Roth is you have to limit what you can put in them, right? So that's the only thing about that. So what else? Absolutely, you can get it for a newborn. The wealthy do it all day long. They actually put life insurance on their children after 15 days. So, because you have to wait at least 15 days for a child to have life insurance coverage. And that is their ticket. That is their way to build wealth because they want another tax-free, policy. So when a child is born, they rejoice because that's another opportunity for them to be able to have a policy tax-free growth, of their money. Their money's growing tax-free. So that's another way to expand. So yeah, absolutely. 15 days, you can put it. And, I did the math for one of my clients that did that for a child, a 1-year-old. If she paid $250, a year, she'd be a millionaire by 58 if they did that, based on the policy type that we were looking at. So yeah, good question. Y'all asking some good questions today. And I just came on. All right. So my fear is starting a policy, then not being able to afford. Okay, great question, Jarvis. So for you would want to be in an IUL versus a whole life because a whole life doesn't have that flexibility. If you miss your premiums, you're going to lapse it because it's guaranteed, right? So it's a guaranteed death benefit. So you don't want to be in a whole life because if you fall on hard times and you don't have money somewhere else, you could actually lapse your policy. Now with an IUL, because you've been paying into it and you got that nice cash value growth inside of it, it'll actually pay your premiums should something happen to you with a job, right? So it's so flexible too. You can actually downgrade your premium from the target amount to what's called minimum amount, right? So let's say your premium is $1,000 a month or $800 a month or $500 a month. Whatever it is, just take that and probably do a third of that or a fourth of that. And that can become your minimum, right? So for example, I have a person that was paying $883, needed to drop down. And they ended up saying, well, I just want to pay $500. And that was fine. No big deal, right? But ideally, if you're using it for a retirement account, you don't want to drop down because, of course, you want to pay as much as you can so it can build up as much as it can. Because basically what you're doing with an IUL is you're generating your own Social Security. So Social Security, we don't know that it's going to be around, 2025 to 2032 is what economists are saying it may go away. We don't know that, but you're generating your own Social Security by having an IUL. So you want to put as much money into it because the more money you put into it, the more income you're going to have. Okay. When you're ready to turn on the LIBR, LIBR, standing for the Lifetime Income Benefit Rider. So once you turn that on, just like Social Security, the younger you are, the less money you're going to receive for the rest of your life. The older you are, the more money you're going to receive for the rest of your life. At 70, you have to start taking money, right? Just like RMDs. So can I move my annuity to an IUL? So what people do with that, good question, Jarvin, is they actually let their annuity generate the income or the cash value. Basically, they let it build up, and that's paying their IUL. So that's a great question. So that's a strategy a lot of clients use is they let their annuity pay for their IUL. So you can't move the after 10 years is your money, right? So after the surrender charge, you can take all your money if you wanted to, and you can start an IUL, but you can't put all that money at one time, and you get a nice little letter from the IRS because they're saying you're treating that as an investment, and you don't want to treat it as an investment, right? So you want to be able to treat that as an IU, as a life insurance policy, as it relates to looking at the that. So when the IRS look at you, they don't want to look at you as an investor or using the IUL or the life insurance policy as an investment. So according to a lot of the codes, IRS code 7702, there's a MEC limit. Okay, it's called a modified endowment contract. So in your policy contract, it's going to tell you can put up to this amount inside of your policy. If you put a penny over that, you're going to send a red flag to the IRS, right? So, and possibly they could tax you, right? And you never want that to happen with your policy, because once that happens, it will always happen. It will always be taxed. So you never want that to happen. So great question. Wonderful. So yeah, Facebook's asking a lot of questions. So basically, the IUL is definitely more flexible in comparison to the whole life policy. So if you have challenges, you can drop down to the minimum. And then, of course, you still have that cash value that's already built up in there that's yours, minus whatever the surrender charge is. You can access to be able to pay off, your premiums. I got my insurance license as a challenge, but don't use it. You are a wealth of info. Well, thank you. I appreciate that. So yeah, if I can help you in any way, Jarvis, just give me a ring. All right. So I love what I do. My story is that, of course, everybody knows me. Know that I lost a couple friends. Just think about your two closest friends, right? At that time in 2018, they both expired. With the flu within 4 days, they both passed away. One lived in South Carolina, one lived in Georgia, and literally one died on like that Thursday, the next one that Sunday, unexpectedly, right? Didn't know what was going on. So the flu, and so unfortunately, they never really was able to live and have a retirement. And so my passion is to help more people to retire before they expire, and that literally is something I came up with. But I want to see people retire before they expire. And my goal is to help you get your bank account on fire, so you're looking for someone to hire, and you're looking to get your life's desire. Now, I'm just turning into a rapper here. But anyway, I'm here to help you. So salute to you for being so thorough and precise with this information and questions. I will definitely be setting up an appointment with you. Awesome, the Nightway. Awesome. Thank you. I look forward to meeting you. Any way that I can help you. I'm actually revising my webinar, overdue, but helping clients. And I'm kind of a, recovering perfectionist, but I have a webinar that's actually coming out here by the end of the week. So yeah, I'd be happy to, give you that. Now, I do have this retirement planning guide, so that this retirement planning guide is going to help you. So go ahead and download that. And so that you can get on my VIP email list, so that I can start sending you more information about all the things that I'm talking about. So definitely want to help you with more information. So I'm just giving you the tip of the iceberg today. I'm already at 27. I cannot believe I've been on here for 27 minutes. It seems like I've been on here for 15. All right. Well, y'all are asking some great questions. I'm definitely about to go. And I'll try to get on as much as I can, but it's hard because every time I want to go live, there's always something that's coming up, calls and different things that's happening. So, but I will, if I don't know which one we're on Facebook. So there is no bell on Facebook or YouTube, but on Instagram, you can definitely go ahead and, hit the bell so that you can know when I go live. All right. God bless you guys. Thank you for liking the video, because when you like it, it gives the video more visibility so more people can watch it. And that's what we want, right? So share it out if you know anybody that can use this information. I know I talk fast. It's a hard deal. I just want to get it out so I can get on doing some other things, but definitely want to get the information. Hi, Isaac. How you doing? So especially on LinkedIn, guys. LinkedIn, y'all got to show me some love over there. All right. Have a great, incredible day. If I can help you in any way, let me know. Again, go ahead and get your free retirement planning guide. I'm Shatika Hustle, CEO of Hustle Financial Solutions, where we help you retire before you expire. So if that is you, we're the ones you hire. Our goal is to get your bank account on fire with a whole lot of lifetime tax-free retirement income that you will not outlive. All right. God bless you. Have a great day. It's always exciting to speak to you. I will see you at the top, because you belong there.